So what can we anticipate regarding the market condition and what you can anticipate, say, over the next year and possibly even the long term? The real estate market has actually done nicely the past couple of years. We have seen the buyers returning to the market. As a result, the inventory level steadily being shrunk down, so lower inventory now than before. And lower inventory means that prices can begin to firm up, which then provide confidence for the buyers to say, look, when I buy a real estate, when I buy that home, I know it's not a depreciating asset. So they have much more confidence to buy. So this is the environment that we are in. However, from about late summer of last year, all the way through February of this year, things began to slow down. With lower activity. Maybe the recovery was a little too fast, so they are taking a little breather. Or it could be the case that maybe the bad weather condition just put people inside their home. They did not want to go outside. For a variety of reasons, things began to slow down. Year as a whole last year, even with that slowdown, was a good year. It's a positive year, but that slowdown occurred in the late part of the year and it continued into early part of this year. Now we may be beginning to see some end of that slowdown. So that slowdown may be coming to an end, and now it could possibly turn upwards, but it remains to be seen. So it still remains to be seen that we have a weaker first quarter for sure, but the second quarter maybe some neutral, stabilizing condition. When I say stable, neutral condition, I'm saying that this year's second quarter may be comparable to what it was last year. So essentially no change. Then maybe in the second half of the year, maybe there will be some release of the pent-up demand, some delayed transaction that did not occur in the winter months begin to show up a little later. So we may begin to see some uptick later in the year. But there's so much uncertainty in the marketplace, both in terms of the economy, interest rates, but also more importantly, policy front. I'm glad that Kentucky is very active in various policy participation at NAR, whether it is in terms of RPAC contribution, whether it's responding to the call to action, because these really make important differences. From Washington point of view, when you say the realtors want this or realtors want to talk, people in Washington at least are willing to listen because they understand their constituents are saying it, so they are willing to listen, whether it's congressional staff, members of Congress, or various agencies. They may not always agree with us, they may disagree, but nonetheless they are willing to listen to our side in terms of formulating their policy, and I think we are at a very important juncture where there could be some important policy changes that may occur that impacts the real estate either positively or negatively, so something that we are monitoring. So all that I will go over in the presentation. And as Linda mentioned, just for the video recording purposes, if you can hold the question at the end, and there will be plenty of time at the end, I anticipate that I will be done by 11, which will leave a good 30 minutes remaining for Q&A. If you have a clarifying question, that graph is the number 30 or 40, you can ask directly. That will help other people. But other just general questions, if you can hold at the end. So let's see what we are seeing. I have both the national data as well as the local market data. Very local market data I don't have, and because you are the experts. You go to the MLS, you pull out the reports, and you can see what's going on in any neighborhood that you want to see. But at the national level, what you see here is that we had a bubble activity back in 2005. Very lax underwriting standards. Anyone who wanted to take out a mortgage could get one. Anyone who did not want to get mortgages, they got a cold call. They were pushed into getting the mortgages. So many people rushed in to buy a home at that time. In hindsight, clearly it was a mistake mistake at all levels. I think it just, whether it's the Wall Street trying to push the subprime mortgages, whether it's the Washington, Fannie and Freddie trying to participate in the subprime mortgages, or even from, say, the real estate industry, including NAR, where to some degree, maybe we're giving false hope to the consumers to say nothing will crash, everything will be fine. I mean, that would be an irresponsible to say that, because we know that things go up and down and we have to look at all the metrics. But things were heated in 2005. It could not be sustained. And then we encounter a crash. And so one see sales going from about 7 million to 4 million. That's about 40% knocking off your business. So whatever business activity, you're cutting about 40% during the downturn. And then you see some stabilization for the next 4 years. From economist perspective, you said, well, this is stabilizing pattern. From realtors' perspective, you say, well, 2008, 40% off business. It was an awful year. 2009, same condition, another awful year. 2010, same thing, another awful year. So economists may be saying statistically things are stabilizing, but from practitioners' point of view, it was 4 consecutive years of just terrible time. But then in 2012, buyers slowly began to return to the market. Jobs were being created. So we saw an upturn, about 10% increase in unit sales. And 2013, another 10% increase in unit sales. So we are in a recovery path right now, except for the part that I mentioned late last year and early part of this year, we are seeing slowdown, but is this slowdown coming to an end? Because the buyers came back, the prices were getting pushed up also, with inventory going down. So cumulatively, price gain of 20%. So you are looking at, in the past 2 years, roughly 20% increase in unit sales, 20% increase in prices. So in terms of dollar volume has increased roughly 40%. So a company running a large brokerage business, their business activity in terms of dollar terms would have increased about 40% in the past couple of years. So very good sign. I should also mention, let me just go back quickly, that 2008 and 2009 period, it could have been much worse. It was awful, but it could have been much worse. At that time, the economy was losing 8 million jobs. People do not want to buy a home when in a job-cutting environment. Even if people have a job, they have anxiety knowing that their neighbors lost job, so they don't want to buy a home. So it was an awful time, and all calculation had implied that it could crash even more. But there was something done in 2008, 2009 period that helped at least the initial phase of stabilization. And that was the $8,000 home buyer tax credit, if you remember. Buy a home and you get $8,000. That was the deal. And that's something that NAR initiated, NAR pushed through it. We know very well some members of Congress who understand the real estate business very well, including a realtor, a former realtor, Senator Isaacson from Georgia. So we made those cases, and we were able to persuade the members of Congress to say this is something that is needed. And people will not buy a home when there's 8 million job losses, but we need to stabilize a very important part of the economy, and that will then begin to stabilize the rest of the economy. So that $8,000 was available for buyers, and buyers responded. So even in a job-cutting environment, people came in. Now, some people are saying, well, maybe that was a wasted taxpayers' dollars. Well, I think the hindsight is that, well, that was the initial phase of stabilizing not only the housing, but the broader economy. And furthermore, the home buyer tax credit went straight to American home buyers. It's not money spent on bureaucrats or money spent on, so it went straight to the consumers. And furthermore, the price tag of that $8,000, something that government did not raise as a result, or government essentially gave away, was about $30 billion. Billion, not million, $30 billion nationwide. And you say, wow, that's a lot of money, of $30 billion. It is a lot of money in Kentucky. In Washington, it's considered a very small sum. in Washington. The broad spending, the stimulus measure they passed at that time was close to $800 billion. And one can debate about the effectiveness of that $800 billion that was spent at that stimulus time. $30 billion is a relatively small sum out of that $800 billion, and I would say that $30 billion homebuyer tax credit did its intended purpose, stabilize the housing and then subsequently stabilize the economy. Locally, what we are seeing is that in 2013, Lexington area actually did better than the rest of the country. The rest of the country saw about 10% increase in unit sales. In Lexington, it was 19% increase in sales. The prices, however, is lagging behind in Lexington compared to the rest of the country. Rest of the country saw a double-digit price increase, while Lexington saw only a 1% price increase. To some degree, this is a good news because this means the buyers are not pushed out of the affordability range. Things are still affordable. This is last year. And hence, the dollar volume situation is that things were up 20% and cumulatively 44%. So at least the dollar volume looks to be national figures. So you are replicating roughly the national patterns in terms of the dollar volumes. Some markets have seen prices rise too fast. In Southern California or say San Francisco area, Northern California, prices right now are rising about 30% from already high prices. In that area, because there's a lack of home construction, limited land, prices are already pricey. Median price is about $700,000. So already very pricey, but it's already rising at a 30% annual rate. At that rate, people just cannot afford, but also from realtor perspective, it's a lot of headache because what's happening is that there's a listing comes on, a lack of inventory, and you have 30 buyers, 30 bids. 29 realtors and clients will go home disappointed. So you have one winner. But even for the listing agent, imagine listing agent has to review 30 contracts rather than reviewing only 2 contracts. So it's a huge headache. So you don't want to have a situation where market is too heated because there's a lot of work involved and people have to restart that process. 29 people who lost their bid, they have to restart the process. So it's frustrating. The fact that Kentucky or Lexington area is seeing more moderate price growth, I think this is a very healthy development. And furthermore, it's a signal that it's not a volatile prices. It's a very reliable price increase, steady price increases that provides better assessment. I mean, the appraisal situation is much easier in a more stable environment. So it reduces various frictions that could be in the marketplace. The broader Kentucky market is less than the Lexington market. So Lexington is doing better than the rest of the state. And also the membership is also beginning to rise because of the improvement in the housing market. But the membership growth, I would say, is a very small increase compared to what we have seen in the past. Pending contracts, the signing of the contracts, not the closings, began to come down from late summer of last year, which I alluded to. So this is just the graph. So it's 2 years of good recovery. Then from late last year, we see the coming down of the pending contracts. But look at the final 3 months, most recent 3 months. It's beginning to move sideways, which means that the slowdown may be coming to an end. And now maybe it will begin to turn upwards. The data is seasonally adjusted, meaning that it's not because we are entering springtime that things are moving up. We're comparing this spring versus last spring. So, those type of comparison. So based on, even after accounting for seasonal factors, we are beginning to see some early signs of that slowdown is coming to an end. Buyer traffic. My staff does survey of about 3,000 realtors across the country to get a good representative. And it's a very simple survey trying to assess some qualitative information that is not yet quantitative. If it's in the multiple listing service, then it is quantitative, hard information. How many listings, how many contracts, listing prices. But we want to know information even before the multiple listing surveys get their data to assess how things may be developing. So this is the reason for the survey that we have. And one of the questions in the survey is related to the buyer traffic. When you hold an open house, how is the foot traffic? Better now compared to 1 year before? Not well? How is it? Furthermore, realtors have a very good sense of the seriousness of the buyers. Are they just neighbors who have nothing to do over the weekend and just browsing the homes? Or are they really a potential buyers looking at every nook and cranny ready to make a bid? So that type of information. And what we are seeing is that the buyer traffic from about late summer of last year began to go down, which then we saw the pending contracts come down. But look at the buyer traffic in the past 4 months. It began to stabilize and also beginning to turn upwards. Again, seasonally adjusted. You know, how is this March versus last March, which is implying that the buyer interest, buyer traffic is beginning to come around now. So this is giving me comfort level that the worst in the slowdown is pretty much coming to an end. Maybe we have 1 additional month because there's always a data lag in terms of reporting. We are already in mid-April, but the data that will be reported is about March figures, so there is a lag time. So aside from maybe 1 more month of some data reporting on continuing slowdown, I anticipate based on the buyer traffic information that the worst is pretty much over. So now we will begin to see that buyers' activity is picking up, closings are picking up compared to so I think the worst is pretty much coming to an end. The other data that we monitor is the lockbox information, Sentry lock. How many times is the lockbox being open? You know, some indication about traffic. And what we're seeing the lockbox information is that you saw the decline that occurred from late summer, again, consistent with all the other information. But now we are beginning to see an upturn. I did not put the most recent month's data, which came to me from my staff yesterday, and it shows even further increase. So the lockbox information is beginning to show that, yeah, there's more showing now than before. So again, the buyers are coming back. Then I received also from Lexington specific lockbox information, and it is showing a very good sign because what Lexington data shows is that I think January, February, the lockbox opening was lower compared to the prior January, February, but in March was stronger compared to last March. So again, in Lexington market, is showing that the buyer traffic is now beginning to come back. So a lot of different data consistent with the idea that we saw the slowdown, but the slowdown is pretty much coming to an end. There appears to be recovery. We don't know how strong the recovery will be, but the slowdown is ending. There appears to be recovery that is beginning to take shape. This chart shows the price condition and sales condition by region in the most recent national housing statistic by four regions. Northeast saw a sales decline, little price increase, and then one moves all the way to the other end, the West region, which saw the greatest price increase, but the largest price decline. What is the takeaway from this? The takeaway from this is to show that there's a lot of blame on the slowdown of the economy or the housing market on the weather. I mean, anecdotally, it makes sense to say that it's very cold, heavy snow, freezing ice. You don't want to go out looking for a home in this type of condition, just simple, logical, natural human behavior. Even realtors will say on a freezing day, they don't want to hold an open house. They don't want to go out on the street and try to put that open house arrow and all that stuff on the freezing weather. So even the realtors don't want to be out in the cold. So people are saying weather is the reason why things have really slowed down. This chart shows that no, that's not the case. Weather may have played some impact, but the biggest impact to the slowdown in housing is prices. Where prices are rising strongly, that's where the buyers are disappearing. So in the West region, where it is seeing a price increases close to 20%, the buyers are simply going away. Some people are priced out. Other people who may have financial capacity are saying, is this price increase for real? So you just give some pause for some buyers when the prices rise so much. So the fact that the prices are increasing more moderately in the state of Kentucky, I think this is a very positive sign that it's not going to be affordability that will be a negative driver on any housing, because there's no affordability issue. People who have a stable job, there is a home for them at various price range. I think the inventory is questionable, is there enough homes? But in terms of the buying capacity, because prices are affordable, it should not be deterring buyers in the local area. Home prices have risen 19% over a 2-year time span nationwide. West region rising much faster. But people's income is barely scratching 1 or 2% growth each year. By the way, I feel a little warm because I think that a lot of people are breathing, and so if we can adjust the thermostat just a little bit, or maybe it's just me because I'm talking. But we already are seeing some mismatch between home price and income growth, and we don't want this to occur on a sustained basis. One thing that we learned from the bubble years is that when prices rise much faster than income for a consecutive years is unsustainable. Something bad will happen. So I think that we are seeing some sign of what occurred during the bubble year, but I would say this is not a return to a bubble or return to a mini bubble, but this is a correction response from overly corrected market. Market crashed a little more than was fundamentally justifiable, and this is just responding to that. Mortgage rates also at the same time is rising, which is always a negative for home buyers. So the 3.5% mortgage rate that your clients had last year, that's done and over with. Now you are in a 4.5% mortgage rate environment. So 4.5% is higher compared to last year, but there are some clients who may be saying, sorry, 4.5%, that's too expensive. Anyone who has been in the business for the past 20 years, or even 10 years, will say 4.5%, we didn't think it would reach this low level. That's what we are. But people are comparing with what their friends and colleagues locked in last year. There's some element of jealousy and envy to say maybe it's possible that it could go down to 3.5%, so maybe I don't need to really rush. Furthermore, there's lack of inventory, there's not a good selection, so there's no reason why I should not wait further. So some people may be thinking that 3.5% is possible. A few years ago, there was a Nobel Prize in economics given to a non-economist, psychologist. But he had economic implications, which is the reason why the Nobel Prize was given. But this Nobel Prize was about anchoring in the prices. What anchoring means is that people like to make a decision knowing that they have compared the alternatives. Without the alternatives, they cannot pull the trigger. They have to know the alternatives. Once they know the alternatives, then they pull the trigger. So what people are seeing in terms of anchor or their alternative for many people is their friends and colleagues, 3.5%. So that's what they're comparing today's rates with, at least among some. And hence, they are saying 4.5% is too expensive. This is where I think the Federal Reserve comes into play. Federal Reserve is saying, look, 3.5% is gone and past. That should not be your anchor. That should not be your comparison point. The comparison point should be what will be the rates in the future. Because Federal Reserve has announced that the easy, loose monetary policy is coming to an end. We are in a rising interest rate environment. And that is a right communication. Now, the Federal Reserve also has been saying they will remain accommodated as much as possible as needed, but still they're saying expect higher interest rate down the road. They anticipate that it will not be an alarming increase, sudden alarming increase, but nonetheless trying to get the consumer's mindset to say, when you want to do comparison, because consumers cannot decide without the comparison, when you want to do a comparison, comparison is not with the past, recent past, but the comparison should be with the future. And if that's the case, then the 4.5% is still a very attractive rate. My guess is that this time next year, it will be over 5%, maybe 5.5%. So that should be the comparison point. Just the other little side application of this theory is that sometimes you show a client homes, and some clients are very good, and other clients, they're a very good person, but they're not a good client. And these are people who are very fussy to say, what about one more home? I want to see that one more home. You have already done everything possible to show everything that was out there within their criteria, but they still want to see one or two more homes before deciding. And then after you show them one or two more, they say, well, maybe one more. They just cannot make up their mind. Well, according to this theory, where they need to clearly, consumers decide once they see the alternative, is that sometimes you really have to show alternative that is not really in their criteria. So even though they gave you all the criteria, you say, well, let me show you this. And it's slightly out of their criteria. It could be on the price range. It could be on the neighborhood, different school district, this. And then you show it, and they clearly realize, oh, if I push out little boundary a little too much, it's in this range, which is clearly not what I want or what I can afford, or it's not what the school district that I want to go into. And then they immediately focus on the homes they have already seen, and they will choose from that. So it's, even though it may, from your perspective, it's a waste of time to show a home they will never purchase, sometimes that is needed in order to make that trigger for your consumers to say, look, you have pretty much seen everything, but any further alternative is really this. So that's what you are. Rates are low, but one of the head-scratching situations is that people are not taking advantage of the low rates. 1/3 of all transactions that have been occurring in this housing market recovery is cash. All cash. 1/3 of all transactions nationwide. I don't know what the figure is here locally. Maybe it's not as high, but still it's higher than normal, all cash. There's some reasoning for that. One reasoning is there are a new set of buyers which never existed before. And these are Wall Street institutional buyers, hedge funds. They raise money and they're going out trying to buy properties. They're just following a simple Warren Buffett recommendation. Warren Buffett, 2-3 years ago on CNBC Live, what would you do if you had extra money and could invest in things? And he said, I will buy 500,000 single-family properties. Well, he has the money, but he did not do that. But he did use the money to buy companies that are exposed to housing market recovery, things like lumber, the paint business, and things like that. So he's doing very well. But the Wall Street listened to him and said, yeah, I think that's a great idea. Things are oversold. Things are bargain prices. Even in Detroit, where you say the city is collapsing, bankrupt, well, you can still charge $300 rent if you buy a property, and that property costs only $20,000. So $300 monthly rent, $20,000 property. The numbers make sense. So you had all these institutional investors raising money and going into these hard-hit areas of Detroit, Orlando, Miami, Las Vegas, and Phoenix. And as a result, this market has seen a strong buying activity of institutional investors going in all cash. Now, institutional investors now recognize Phoenix is now no longer affordable. Las Vegas is no longer affordable, so now they're going to second-tier cities. They're looking at Atlanta, Memphis. They're looking at St. Louis. So I'm not sure if there's any presence of institutional buyers, say, in Louisville or in Lexington, but they're looking around to see where there's a bargain situation. So institutional investors went in all cash, but they're still not a very large segment of the market. Even nationwide, they only represent about 5% of total transactions. In Las Vegas, maybe it's up to 20%, but nationwide, they're only about 5%. But this cash is still high. So who are these other cash buyers? Other cash buyers are you. What do I mean by you? When we take a survey of realtor members, half of realtor members own investment property. Because realtors save their money. Do they buy stocks? Do they buy bonds? Or do they buy real estate as a rental income? Realtors are very familiar with real estate, so they say, maybe I want to put my money savings in a rental property. So half of realtor members have rental properties. Mom and pop investors. Mom and pop investors can no longer obtain mortgages. So only way for mom and pop investors to buy their rental property is to go in all cash also. So there's mom and pop investors pretty much have to go in all cash. The third group is just genuine home buyers who want to live in their home. They may be fortunate, they have cash wealth, so maybe that is helping, or maybe they're lucky to have that rich uncle. Stock market has done well, and you said, I want to buy a home, and the rich uncle see that, yeah, buying a home is a good thing for the long haul. Prices are still attractive. And the rich uncle also recognized the young kid cannot obtain mortgages. And when I say young kid, people in their 20s that cannot obtain mortgages. So the uncle say, guess what? I am going to buy that home for you all cash, but you pay me that 6% interest rate to me. So in a sense that you have a family member acting as a private bank. So even though the transaction is all cash, there's a family borrowing situation. So that could be another reason why it's occurring. And also anecdotally, I hear from the realtors is that inventory is short, there's multiple bidding. Only way to win the bid is to go in all cash. Without cash, you cannot win the bid. So you go in all cash, find the money somehow. Just find it, go in all cash. 6 months later, get a home equity loan. So in a sense, people are getting their mortgage after the fact. So they're first purchasing all cash, but getting the mortgage after the fact. Refi activity is collapsing because we are in a rising interest rate environment. It is already higher rate now compared to 1 year before, and it's anticipated to be about 15-year low. I know that many realtors have family members who are in lending business. They're in for some tough time. Because refi activity will be collapsing. So any income generation from refi will pretty much disappear. The only people who may be refining is people who need cash out, whether for hospital bill, college tuition. If they need a cash out, then they may do cash out refi. So that will be about the only reason they will not do refi for interest rate, because interest rates are rising. So refi activity will be collapsing. If you don't have family members in the lending business, you don't care about this. And also, this has implication about home buying. How is the following. Banking industry has raked in huge profit from doing refis over the past few years. And also, the banking industry can borrow from the Federal Reserve at zero interest rates. When we say zero interest rate policy, monetary policy, it's not for you. It's for the banking industry to borrow at zero. And whatever they lend it out, that's the profit margin. So the refi business, zero interest rate policy has really helped the banking industry. And also note that little negative. That's when the financial market was crashing at that time. And that's when also the Washington provided that TARP money, $700 billion to the banking system. Now, most of that money is paid back, so it's repaid, but that's when that $700 billion came into play. Aside from economic stimulus, which was separate, $800 billion. So again, that homebuyer tax credit is a very small sum in the big picture. So the profit levels are very high. Now that the refi business is going away, it means that the banking industry have to look for a different line of business because their profit growth will not occur from refi. Refi is collapsing. They are sitting on pile of cash. What business could they expand into? Well, what about for home purchase mortgages? Because home purchase mortgage market is been not really turning upwards. We had this housing market recovery because of the cash transactions, not really because of additional mortgage accessibility. As you know, mortgages are very tight to obtain. So now that the banking industry their refi profit business is disappearing, I think they will be looking towards other line of business, and this is for home purchase mortgages. From banking industry, you have two applications, one for refi, one for home purchase. Refi is much easier. You already know the payment history. You already know you don't have to worry about the appraisal issue. So refis are much easier, but that refi is going away. Now they will be looking at home purchase applications. Home purchase application last year has been on the bottom of the pile. Now they're going to the top of the pile, and they will begin to have a second look at it. Wells Fargo is the biggest mortgage lender in the country. Last year, to obtain FHA mortgage from Wells Fargo, they said Wells Fargo private company criteria, not government regulation, their own decision, said person has to have credit score of at least 700. If it's 690, we will not even consider for FHA. That was Wells Fargo's private decision last year. This year, they changed, and they said the following. They said, guess what? For FHA loan applications, we will consider credit score of 660. Not approval, but consideration. So at least they're willing to go down the line in terms of the credit score because their refi business is collapsing. So they're looking at other business opportunities. So some people who may have been rejected buying a home or rejected in terms of mortgage applications, maybe this year they may get an approval. It's possible. Because at least the banking industry is beginning to say we are willing to look at people down the credit scores spectrum to see if it makes sense. So the market incentive to lend more is clearly present for home purchase. Huge cash reserve, just sitting on pile of cash. Refis are going away, and purchase is the only game in town. And the loans, by the way, are performing outstandingly. First, loans went to people on the high credit score, so they are not defaulting. But second, there's far fewer delinquent mortgages today because we're in a rising home price environment. When home prices rise, people want to make that mortgage payment. When home prices decline, people say, well, do I make the payment or not? Do I walk away? But if home prices rise, there's an incentive to make the payment, and because home prices are rising, people are saying, I will make the mortgage payment. If they're in a financially difficult situation, they are saying, I will make the mortgage payment, but not the credit card payment. Because they know their housing, there's their wealth. They don't want to give up their wealth. So we are in a very good situation where loans are performing well, huge cash reserve. So it looks like a simple thing. Make more loans, and then there could be additional profit to the banking industry. But will Washington allow this to happen? So it looks like the banks have huge incentive to do so, but will Washington allow it? First, G fees and FHA premiums. G fees are hard for ordinary consumers to understand, or even ordinary realtors who are very busy, driving around and showing homes. G fees are guarantee fees for Fannie and Freddie. The loans that your client obtained, whether from Bank of America or local community bank, they were able to obtain that mortgages because the lender knew they can sell it to Fannie and Freddie. If they could not sell it to Fannie and Freddie, they would not have originated the mortgage. But they knew that they could sell it. That's why they originated the mortgage. Fannie and Freddie charges the lender something called G fee, guarantee fee. But they have drastically raised this guarantee fee, which is making it more difficult, more costly on the mortgages. 4.5% mortgage rate, very good historical perspective. But without this excess guarantee fee, mortgage rate would be 4.1%. But it's 4.5% today. So it has some impact on the consumers. And you say, why is there a guarantee fee? Well, guarantee fee is partly because Fannie and Freddie made huge mistake during the bubble years. They crashed. They had to get a huge amount of taxpayer money, $180 billion. But Fannie and Freddie has now repaid all their money because loans are performing outstandingly. Given that loans, that bailout money has been paid back, why is there still a high guarantee fee? You have to ask that question. And now Fannie and Freddie, they're making huge profit even after paying off the government. And now they're using, because Fannie and Freddie is effectively now nationalized, they're turning over their profit over to the Treasury. So it's helping, you can say, help reduce the budget deficit. Maybe it's good. They're using that money to pay for food stamps. They're using that money to pay for tanks. Whatever it is, all that Fannie profit is being turned over to the Treasury, and the Treasury is just spending as however they're doing it. But if the Fannie and Freddie was created for the intent purpose of housing, why is that money going for non-housing matters? And why is the guarantee fee still high? So that's a question worth asking. The other question that worth asking is FHA insurance premiums. FHA is for moderate income families who want to make it into the middle class. You look at the FHA insurance premium today and it is outrageous. You look at the prices and it's almost as if FHA government is trying to rip off the consumers. So outrageous in terms of the insurance premiums. Now, high insurance premium was very similar for the reason as Fannie and Freddie. FHA needed some bailout money. $1 billion, by the way. Again, in trillion-dollar government spending, $1 billion is a small amount. But because FHA needed a bailout money, they said they need to raise the fee to cover these losses. So in a sense, current home buyers are paying for the sins of the past. But this FHA insurance premiums are also will be such that by end of the year, bailout money would have been paid back already. So again, once the bailout money has been paid back, should the insurance premium remain high, or should the money be turned over to the Treasury and for the Treasury to use it as however they wish, whatever government program there is? But right now, Washington is making it very restrictive in terms of mortgage availability. QRM, something that you should not know it unless you are very actively involved. But there are only few people who are actively involved, and those people who are actively involved in policy matters, who attend NAR meetings and so forth, they are aware of QRM issues. And they are representing your views, even though you may not directly participate, but they are representing your view. And what is QRM? When they first came out as part of the Dodd-Frank financial market regulation, it said that maybe we should consider imposing 20% minimum down payment to buy a home. 20% minimum down payment. We did some analysis. If that was the case, 40% of your clients would disappear. And furthermore, it would delay home purchase for most Americans by an additional 13 years. So rather than buying home, say, this year, if they have to come up with 20% down payment, they have to wait another 13 years to buy a home. So you would be quite devastating to the real estate market if that was imposed. But we have to show all the data. We had many meetings with the policymakers on this issue. And now that 20% minimum down payment issue, I don't think it will get implemented. Because we share data. I mean, one of the data point that we shared was look at the Veterans Affairs mortgages for veterans. It is performing well. No government bailout. It's working very well. And you say, why is that? Well, yes, zero down payment. But zero down payment is working well. But how is it possible zero down payment is working well? Because the system was set up so that if the veteran wanted to take out a large mortgage, the Veterans Affairs said, well, guess what? We have to deny you that loan. However, if you scale down and stay within your budget, we can approve it. So it forced people to stay within their budget, and then as long as people stay within their budget, loans perform. So it's not really about down payment, but it's really about people staying within their budget. So when the 20% minimum down payment was proposed, we were the first out there just showing the data, all this part. But now I think it's the case that they are clearly moving away from that 20% minimum down payment. So you should thank your local president, state president, and others, because they go to Washington and they represent your views about those type of issues. The other factor that may be hindering lending is that Department of Justice, it seems like every 3 weeks there's a huge lawsuit against big banks. So JP Morgan, $4 billion lawsuit. $3 billion lawsuit against Bank of America, whatever that figure may be, you see it. So what do these large banks do when they hit a lawsuit? Well, they can either try to fight it to say, this is unreasonable lawsuit, we did not do anything wrong. And we can, in fact, we actually helped out in certain areas, picking up some bad mortgage companies because during the financial crisis, government asked us to pick up some bad mortgage companies. We didn't want to do it, but they asked us to do it. We did them a favor. But now the government is suing that you were part of the bad mortgage lending by picking up those affiliates and whatever all that is. But the J.P. Morgan, Wells Fargo, and others, what they're doing is when they get hit with a billion-dollar lawsuit, multi-billion-dollar lawsuit, they're saying pay it off quickly. We don't want to be on the headline of Wall Street Journal. We don't want to be on the front pages. And so they will admit no wrongdoing. But they say we don't want to be on the news. Pay it off. So if the big banks are getting hit with lawsuits, then in a sense, all that cash reserve they have to lend, good portion of that they are reserving for lawsuits. So in other words, that money is not coming to the main street, but rather it's being reserved for all this potential lawsuit case. And mortgages all in the meantime are performing super well. So again, the market incentive, let me just go back. Market incentive is there's plenty of market incentive to lend more, but it appears to be some hurdle related to what Washington is doing in preventing that from occurring. Dodd-Frank bill, by the way, is, if you ask many of the local community banks, smaller banks, they are saying this is the biggest burden they've ever faced in their business history. So the large banks, they are saying it's the lawsuits. Large banks don't care so much about Dodd-Frank bill because they have a huge legal staff. They can look through it, what is right, what is not. They can easily comply. Small banks, they don't know what to do. 2,000 pages of new regulations, and they're frozen as to what the new regulation means. So it's essentially strangling many of the smaller banks about what kind of business they can do or what risks they can or they cannot take. So Dodd-Frank bill is really hampering many of the local smaller banks, while the large banks are being hampered by the Department of Justice. Now I mentioned Dodd-Frank. Usually, I like to stay out of politics, but I will be mentioning something bad that the Democrats are doing and something bad that Republicans are trying to do, because I want to be an equal fighter. By the way, about RPAC, to whatever degree that you can contribute to RPAC, that's the key thing that opens the door in Washington. Some people may be very cynical to say money in politics. I don't believe that. But the nature of it is that to be elected, the candidates need money, and if someone is willing to provide the money, they're willing to listen to your perspective. NAR is considered one of the largest contributors in Washington in terms of political activities. But unlike other organizations, NAR is very unique in the sense that year in, year out, half of the money goes to Democrats, half of the money goes to Republicans who are very pro-real estate or willing to defend real estate. American Bar Association, 100% of their money goes to Democrats. Chamber of Commerce, 100% of their money goes to Republicans. So our organization is very unique in Washington in the sense that we actually have friends on both sides of the aisle. Not everyone, there are some Republicans, some Democrats completely disagree with us, and that's one unique fact. So for RPAC, whatever you can contribute to, whether it is your fair share amount of $15, other people contribute more. You can look in the back, there are people who have contributed $25,000 over their lifetime. All this makes a huge differences in terms of how NAR is able to make voice in Washington, including about 20% minimum down payment, including about the home buyer tax credit. Recently, flood insurance bill was passed. And you say, or at least people in Washington now, there's no way that flood insurance bill will ever get passed. Well, at the end of the day, it got passed because realtors explained that maybe some people should not be living in the flood zone and they should pay higher premiums. But to say that the insurance premium should go from $2,000 a year to $20,000 a year just doesn't make sense. How can you have an elderly couple who are living in their home for a long, long time, used to pay $2,000, now they're asked to pay $20,000? That's just ridiculous. So this bill was passed to call a timeout period to say, let's not increase it at such a fast rate. I mean, we should do more evaluation study and so forth. But things like that, things that people in Washington said there's no way it's going to be passed, but it gets passed because realtors' influence in Washington. Now, Dodd-Frank is strictly a Democratic bill, Senator Dodd from Connecticut and Representative Frank from Massachusetts. After they passed this 2,000-page legislation, they conveniently retired. Also the new qualifying mortgage rule is part of the Dodd-Frank bill. Qualifying mortgage rule meaning that 43% debt-to-income ratio one cannot exceed. For Fannie and Freddie FHA, one can exceed, but thinking in Washington is they want to drastically reduce Fannie and Freddie, reduce FHA, which means that more and more loans will fall under that 43% debt-to-income ratio cap, and that's part of the Dodd-Frank. And we think that's too restrictive first, because there are some special cases where for some people, maybe 45% makes sense. You know, you have young couple, recent graduate of medical school, recent graduate of law school. They are huge income potential. They found a job, stable job, huge income potential, but because of student debt load, they're outside of their range. But they will be perfect candidate for good home buyers, yet they will be denied a mortgage under the new qualifying mortgage rule. So less flexibility. And furthermore, part of the qualifying mortgage rule is the following. In the past, when the lenders made mistake, lenders lost money. Now, under the qualifying mortgage rule, lenders make mistake, government will sue the lenders. So there's a lawsuit risk attached to it, and hence the lenders do not want to go above that ratio. So that's all part of Dodd-Frank. Democrat. Now, having attacked Democrats, now it's time to attack Republicans, which is the very last one, the new restriction, potential restriction on PATH. So what is PATH? Well, first it's introduced by Representative Henselung from state of Texas. So Texas, obviously, a Republican. And it's a very innocuous statement, protecting American taxpayers and homeowners, PATH. Who could not be against that? Protecting American taxpayers and homeowners. But what does it do? Well, it would essentially get rid of Fannie and Freddie. Now, Fannie and Freddie, you look at it in hindsight, they made a huge mistake. They were arrogant, and you can use other bad words towards Fannie and Freddie, particularly their multi-million-dollar salary receiving managers. They're all fired. Now they're effectively a government agency. Now, in some private market activity, you want only the private market to be involved. You don't want government to be involved. I'm sure many of you have smartphones. Never trust government to produce a smartphone. They will mess it up. You want a private market to produce smartphones. But in area there is a very boring product. This is where something government can do well, provide, and mortgage availability, that 30-year fixed rate mortgages have been around in America for generation after generations. Ever since the Great Depression to the end of the Second World War, 30-year fixed rate mortgages. America is very unique in that aspect. Other countries don't have 30-year fixed rate mortgages, but we are accustomed to it. It provides that fixed, stable payment stream. It helps you fight against inflation. If there's inflation, your mortgage payment do not rise. So it's a very good thing. But Fannie and Freddie, if they disappear overnight, that 30-year fixed rate mortgages would essentially disappear or become very expensive in order to obtain it. Another part is that once you remove Fannie and Freddie, then you have the large banks doing the mortgage-backed security. Without going into details about the importance of mortgage-backed securities, large bank would have advantage over smaller banks. And I'm not sure that's a healthy development. I think there's always some competition from small banks that is healthy for the country. And the other part is that so it's not going to protect American homeowners, because American homeowners will no longer have the 30-year fixed rate mortgages, and interest rate would be much higher. And also, by the way, commercial real estate loans, which does not have Fannie and Freddie backing, so commercial real estate deals, trying to buy office properties and others, it doesn't have any government backing. Guess what happened during the financial market crisis? Loan availability collapsed by 99%. Imagine if the residential mortgages collapsed by 99%, what would have happened? So because of the government backing, at least even during the bad time, at least it flows a certain amount. Not the normal amount, but at least there was some flowing of activities. So without government guarantee, one can anticipate a potential total collapse during certain times like financial market crisis. The other part is that protecting taxpayers. I'm not sure if that's the case. If the large banks would be doing the mortgage-backed securities, and let's say they make a mistake. I mean, they made a mistake on the subprime mortgages, but let's say they make a mistake. What happens? Well, you can walk to any banks and he has a big sticker, FDIC guarantee. So banks will go under, but taxpayers will have to pick up the tab. So just somehow, because one believes that Fannie and Freddie were arrogant, Fannie and Freddie made mistakes, and they did. They were arrogant. They made huge mistakes, but all the managers have been fired. Now they're going back to the very simple role to say our role is behind the scene to assure that American consumers have access to 30-year fixed-rate mortgages. This mindset can work, has worked well all the way up to prior to the bubble years. And there was the bubble where these arrogant managers came in. That's when things blew up. So I think the NAR policy, we have various committees all around, and all the NAR members through the policy said this PATH legislation is a terrible idea, and we want to make sure that it doesn't happen. And I can tell you that the update on this PATH legislation is that it passed in the committee that oversees this in Congress. Bipartisan vote. Republicans say, yes, let's pass the PATH Act. Democrats saying no. But at the full House, it has to pass the full House of Representatives. John Boehner, who is a good friend of Realtors, said there's no way I'm going to introduce this bill at the full House. So this is not being introduced at all at the full House. But we don't know. Maybe next year, after the elections, new members come in, new dynamics, they elect new Speaker of the House. You don't know what's going to happen, and this could be reintroduced and possibly gain some traction. But this is something that we are monitoring. But I think we have done enough education to the congressional staff that I think this will steadily die away, even among the Republican congressional staff. But still, we need to be very mindful and watchful of this. All right, so let's see what the time. Oh, wow. I have really passed up on the large amount of time. So let me move a little quickly because I want to give you a question and answer session. Inventory levels are low. On existing, it's at 50-year low. Existing home inventory is at a 13-year low levels. And some people say, what about the shadow inventory? Well, the shadow inventory in the state of Kentucky is making some progress. These are seriously delinquent mortgages or homes in foreclosure process, not yet REOs. So from the bubble year mistakes, there is some progress being made. It's not back to normal, but there's some progress. Look at the state of New York. There's no progress in the state of New York, but in Kentucky, there's some progress. Other states are making faster progress compared to Kentucky, but given that there is a shrinking shadow inventory, means that there will be fewer distressed property sales going forward automatically because there are fewer in the pipeline. Because of the lack of inventory, what we need is more home construction. So we need more builders' activity. This is nationwide. Horizontal line is the long-term average. We are recovering, but we are still short of that long-term line by a large gap. Housing start needs to increase about 50% to reach that large gap. And no one is anticipating, which means that inventory shortage that you are encountering, it will be with you for the rest of the year and possibly even next year. State of Kentucky, this is the housing start situation. So one sees that maybe 2005 there was too much at 23,000, but maybe 17,000 is normal, but you are well under that level. Anything builders build that can sell. Ask the builders, anything you build you can sell, why are you not building if you can sell it? And the answer is community banks provide the construction loans. Community banks are strangled by Dodd-Frank regulations and they cannot make those construction loans. So this inventory situation could be easily solved with new home construction, but new home construction is not occurring because the local builders cannot obtain construction loans. Some local builders who are very creative in finance or have huge cash reserve, they have a huge advantage. Other home builders who are at an advantage is the nationwide companies, NAR, KB Homes, Toll Brothers. They don't need construction loans. They go to Wall Street, issue stocks and bonds, have the money, and then use the money to buy lots of lands. So they're moving in. But we need many small-time builders, and small-time builders are shut out with only large builders taking advantage of the fact that small builders are shut out. Lexington, a similar trend to the state of Kentucky. This is the price trend. So again, showing that prices are very steady in Lexington compared to the Phoenix market. Phoenix, huge bubble, huge crash. But I think this data is lagging. I think it will soon be turning upward given you are having falling inventory situation. No recession in sight. I think the first quarter GDP will be coming out in a couple of weeks, and that number will show almost recession territory, but there are a lot of special factors. I think second quarter, third quarter, it will be much better numbers. I don't see a recession. Consumer spending remain positive, and household net worth is at an all-time high. And I think this is the reason why consumer spending will continue to remain positive. Just one little quick comment on this is that it's an all-time high because stock market is at an all-time high. 99% versus 1%, that's a wrong figures. What is real figures are 90% versus 10%. 10% of Americans have meaningful investment in the stock market. When stock market rises, they benefit. 90% do not have meaningful investment in the stock market, so they don't participate in the stock market recovery. Which is the reason why half of Americans say we still feel like a recession, even though we have highest net worth, because only the 10% are really benefiting in the current stock market recovery. Business spending is positive, and businesses have plenty of cash to spend. So their businesses are being extra conservative in terms of spending. Usually the red line should be greater than the blue line. Spending is larger than the profits because small businesses borrow money to spend. But note today, it's not the case, which means that there is less entrepreneurial spirit in America than before. But still positive because it's moving upwards. Jobs, we have recovered most of the job that's lost. Therefore, because of job creation, unemployment rate is falling, now almost 6.7%. 6.7%. Soon as I mention unemployment rate, people raise their hand and say that's wrong figure, it doesn't account for that and all this factor. So here's a cleaner figure. Employment rate, how many of the adult population have jobs? Not how many people do not have jobs, how many people have jobs, how many people are working? Is 58% of American adults are working. Before recession, it was 62%, 63%. So even with job recovery, we're only treading waters in terms of what percentage of adult population is working, which means that job creation is only treading water with population increases. Kentucky job, following the nation trend, one sees that down and almost back to the prior peak. Lexington, it's almost, it's doing better. Louisville is doing well, not the Cincinnati area as much, but Lexington and Louisville is doing better compared to the Cincinnati market or Northern Kentucky market. The forecast is that first, general economic forecast is that I believe that inflation will begin to pick up because there's so much printing of the money, and eventually the printing of the money will translate into higher inflation. So I see inflation possibly popping out to 3 to 5% by next year, which means that Federal Reserve may need to raise interest rate a little sooner than anticipated. So from your consumer's point of view, interest rate will rise, but it may be rising a little sooner than anticipated. One of the reasons why inflation is expected to rise is I look at the housing component. The apartment rents are rising at 3%. And the blue line, which is something called homeowner equivalency rent, is a very fuzzy number. You as a homeowner, how much rent would you charge? How much rent would you charge as a homeowner? Well, you don't even compute that because you are never going to rent your property, but someone in Washington computes that for you. And they have that figure. But blue line should be something close to the red line. If the apartment rents are rising at 3%, surely your home rent should be rising 3%. So if that's the case, I think then that will push up the inflation. We have housing shortage, apartment vacancy rates are going down, rents will be rising and rising and rising. Second forecast, housing market forecast. First quarter is slow, but I think the second half will compensate for that because of job creation. And once the consumer's mindset is that we are in a rising interest rate environment, and they recognize 4.5%, 5% mortgage rate is still a good bargain. So I think the second half will be better than the first half. So therefore, total sales will not change all that much. The prices will rise because we're in housing shortage, and therefore dollar volume will be positive. Next year, I think the pent-up demand for housing will continue to be released, and therefore I think there will be even better pickup in dollar volumes next year. A housing shortage still continuing into next year. Third forecast is more of a social commentary for people to consider. This chart will be available to you if you want to study later, but let me just go straight to the graphs, which is that rental population is rising, homeowner population is not. So let me do it one more time. Rental population rising, homeowner population not. We are not yet a renter nation. We are still a homeowner nation. 65% of Americans own a home. But that figure is going down and down and down. But the rental population is rising. And look at this chart from the Federal Reserve. How much do the renters have in net worth versus homeowners? Renters have essentially $4,000. Everything they have minus everything they owe. Average renters have $4,000. Homeowners have substantially more because their wealth is tied to their home. Many homeowners have paid off their mortgages after 30 years. Some homeowners are underwater, but on average, that's the case for homeowners. Now that the bubble crash is over, we're in a rising housing wealth environment. But three charts, this, says that America will be more unequal irrespective of what Washington does, as long as you prevent good renters from converting into homeowners. So as long as that is the case, it doesn't matter what Washington tried to do, America will become more unequal from simple graph of this situation. And finally, my staff does many survey of home buyers. What do they want? What do they value in realtor service? This is a very small, tiny slice so that it encourages you to go to our website and see the full report on it. And one of the things that we are finding is that there is an increased preference for a condominium style of living. So just, I think the baby boomer retirement, some are seeking trade down. Other part is that people are now very favorable to walkable communities where they can walk around. So you show a home, say, you can walk around the neighborhood, or if it's a condominium, show that, one can walk around to a restaurant. So people are desiring that walkability features. What do buyers want most from their agents? Many people go to a website, look at their home, but at the end of the day, the home they purchase is not the home they first saw on the internet, because it was a dead listing, whatever, all that part. The home they purchased was the home that realtors really showed. So that's where they really see the value. So initially, they may start out on the internet, but at the end of the day, it's about walking to the property, looking at different homes. So that's what they value. And finally, the median income for the realtors are rising because we are in a recovery path. But I look at the last two bullet points. How many have six-figure gross commission income? This is not net, this is gross. And 20% of realtors have six-figure commission income. 20%. 1/3 of realtor members have less than $10,000 in gross commission income. What does that mean? That means that this is highly entrepreneurial, your specific business model. Some business model work well, others don't. So it's all about you as to how so don't expect that everyone will be receiving the medium commission income. That's not the case. And good news is that even though we are seeing housing market recovery, we are seeing only a minimal increase in membership. And I think this is healthy. Because look at the bubble years. Market was good, everybody rushed in. They quickly realized it's not easy, people left, along with the crash. But now you are getting larger economic pie, but not necessarily with more members trying to chase that pie. And I think that's much more healthier development. But we have no control over membership. It's all free entry, free exit business. But right now, we are not seeing that huge increase in membership, which I think is a very healthy development. Commercial market, I did not cover, but commercial market, there's also policy arena to it, but I'm running out of time, so I will not go into it. Anyone who has a Twitter account, by the way, you can follow us. or you can tweet about this meeting or whatever it is. I don't have my own personal Twitter account. But many of the younger people, they say, if you want to be hip, you have to have a Twitter.